I am changing my opinion on something. I've shared with you over the last year or so that I thought the opportunity in the commercial real estate market would probably be about 18 months in duration. Uh, I'm now changing my opinion pretty significantly. And a lot of this has to do with my conversations with Jonathan Twomley, with Anna Kelly, and of course, reading about what Kevin O'Leary is saying. And Kevin O'Leary has done a wonderful job of outlining the series of dominoes that will be falling in the commercial real estate market, the regional banking market. Plus, I have experience with banks doing extend and pretend. So, Anna, I'm not sure if this is good news or bad news, but it seems like the pain cycle in commercial is going to be longer than I expected. Maybe, maybe that means the depth's not as great, but I don't know. What do you think of all that?
So I haven't read Kevin O'Leary's writings of recent or heard his recent interview and what his points are, but just kind of my gut instinct is, some argue that we're already at kind of the point of pain, and that cap rates aren't really going to go much lower because basically, all of the buyers right now are on hold unless they get a steal on a deal. And right now, there are still lenders who are extending and saying, we'll work with you, just keep making your payments, or being willing to refi. And you're seeing some of that in these large, large operators. With that said, though, if interest rates stay higher for longer, and I think they will, history says, regardless of what Marcus and Millichap and Cushman Wakefield and all the big brokers will tell you, history shows that if rates stay high for longer, cap rates will adjust. And so cap rates, if rates go up, cap rates will go up and there will be further fall in prices. And so that is one reason I believe that we could have this pain extend for a while, because all the buyers are kind of hoping if I can just hold a little longer, rates are going to come down and then we'll save our value and we'll save our property. The other piece of that is the lack of liquidity in the commercial lending market right now. And typically, commercial banks do not pull back on lending until you're 6 months into a recession. And then it usually stays pretty tight for at least 2 or 3 years during a recovery. The banks have already started to pull back funding. And so, when I could borrow at 75% to 80% LTV pretty easily, it's very difficult to get anything financed at any less than about 63 to 65% LTV. And many lenders are only offering 55% LTV. So when you have a lack of liquidity, that means that even the buyers that see opportunity have to pay a lot more for that opportunity in cash up front. They have to raise more money from investors, because most people don't realize I'm not just coming up with all my own cash to buy a $50 million apartment building. I'm borrowing from the bank for a piece of it, but then I have to raise money, equity from investors who want way more in their interest rate than the bank does. So when banks pull down LTV that they'll lend on, I have to seek more investors who want higher returns for a greater piece of it, and it's no longer profitable. So what does that mean, Michael? If rates don't come down and banks don't start lending a higher LTV, you're kind of at a standstill, and that standstill is going to last until the economy is healthy again, rates start coming down, post-recession potentially. And then we have to talk about the banking crisis. And the fact of the matter is, although we haven't seen a lot of more regional banks fall, a lot of their loans have not yet basically been wiped off their books. They haven't been foreclosed upon, and there's still a wave of that to come. And most of it, again, I think this is what Kevin O'Leary is probably looking at, was financed between 2020 and early 2022, which means they're coming due for renewal between now and 2025 with 1 or 2 one-year extensions. So that could put us all the way into 2027 before we see the tail end of the fallout of all of that, which is 4 years from now. So I think that there's continuing opportunity as these loans start to fall out, as rates stay high or potentially higher, cap rates adjust, money lending is tight. Those things take time to go through the system. So it's not a once and done. Commercial real estate has fallen and therefore there's deep discounts. It's a rolling falling of commercial real estate values and opportunities for us that can take them down and figure out how to do it profitably. So that's my
Yeah.
long-winded answer to your question.
No, I think it's absolutely right. I think there's so much pain in the regional banking system that each bank, aka operator, is going to make individual choices on individual assets / loans and operators, right? It's
Yes.
going to kind of be, I don't know, a tripod, right? Is this a good and seasoned operator, right? The GP, if
Yes.
you will. Did they just get caught with a bad debt structure? Okay, let's extend and pretend. Is the asset in trouble? Well, we better get rid of that. Is it an inexperience? I think they're going to go through this whole, almost Rubik's Cube like kind of analysis and pick some winners and losers. But also some of them they can't foreclose, right? It would hurt their balance sheet to such a level that they just can't. And of course, they're not lending on new deals. The regional banking is just it's just a complete mess. And to Kevin's
Yeah.
point, it'll probably be that way for the next 3 years. And I think the end result is there's less regional banks. I think consolidations or forced marriages
Yes.
are one outcome, right? Kind of take two bad and stick them together, and maybe you get one semi-good bank. Um, but I think the real point of Kevin's thing is it's gonna be a while. And more to your point, you're gonna be an experienced operator, networking, looking at lots of deals. But I think we're gonna have a longer time frame. I really thought this might be over by the end of 24. I'm not even sure it really starts in earnest until 2025 now. So, uh, I think opportunities will be years in the making, to your point.
Yeah, and I think too, you have to understand that buyers are starting to understand the need for a risk premium again.
Yes.
In 2021 and 2022, it's kind of like, okay, well, I can buy it and break even, but that's okay because I'm going to get 15-20% rent bumps when I'm done with my
Right.
value add, and my cap rate's going to go up just ever so slightly. I'm going to be 100% full and everything's going to go great. And the reality is starting to settle in that, this could take years. We don't know. Again, go back and listen to the first video, but we don't know where the economy is going. We don't know where rates are going. They're seeming that they're going to have to go higher for longer,
Mhm.
and that could mean a cap rate adjustment and some pain in the economy. And so now, as a buyer, and I am a commercial real estate buyer, I'm looking at deals all the time. I have to go, not only do I have to get it for a good deal today with investor money, being paid out at 18 to 20% returns to my investors. If I can't do that on the buy, I can't assume that
Mhm.
everything is going to be rosy, over the hold period and only get better. I have to kind of assume now that there's more risk that my cap rate goes up and my value falls on a net basis if I don't do anything with net income. I have to assume that getting that new income is going to be harder in challenging economic times, whether it's recession or more inflation hurting my renters' pocketbooks. And I have to also assume that my expenses, my taxes, and my insurance are going to continue to go up. And so I'm assuming more risk in the next couple of years, which means I don't want to take over someone else's problem and not pay myself a substantial premium, a risk premium for taking on that risk. And right now, Michael, I can tell you, I look at a lot of deals, and even the ones with assumable debt that minimize the risk of the debt cost going up. The price that they need me to pay just to get them out of the property is still not sufficient to pay me a risk premium. And so you just
Right.
like you've got kind of this standstill in the housing market in the residential world, you have buyers that are finally going, okay, I need a risk premium on day one when I buy it.
Right.
And that risk premium, that profit that I have to make has to be much higher than it was before. So that means these sellers are holding on, trying to sell, trying to find a buyer that'll take it at a price that they're not losing all of their money, where they could just hand it over to the bank and, and walk away. So I think that pain it's like what we in Texas we call it a Mexican standoff, and that's in no way derogatory to Mexicans. I got many family that are, but that's what we call it, a good old Mexican standoff or a good old Texas showdown, like the Astros and the Rangers. They're playing chicken, and the sellers are losing, and so buyers are being very cautious, and we're not scooping up a ton of deals at a great basis yet. The pain isn't there enough for the sellers. So I don't think that pain really comes till the banks go, we're not helping you. We're not refinancing. We're taking it back. And then they have to hope they can quickly find somebody. So 2024, 2025, definite pain, probably through 2026, even 2027. There's going to be great opportunity for buyers and pain for sellers.
Yeah, you don't want to be a forced seller in a market like this, either a bank or an operator that got caught with a bad debt structure.
Right.
Anna, where can people find you?
Great. You can find me at social media, Anna Kelly, REI Mom, here on your show on my playlist, and at my website, Anna Kelly Investing, for real estate coaching and consulting, deal review. If you're looking at a passive deal and you want to know whether it's a good deal on a risk adjusted basis, I offer consulting for deal evaluation and things of that nature as well.
Awesome. Thank you so much.
Thank you.